Hello, and thank you for joining the private credit panel discussion. We're going to kick off with a focus on the competitive landscape and some of the market dynamics playing out in the space. But before we do that, let's ground ourselves in the strategies employed by the managers here. So I'll ask each of you to hit us with three things. What segment are you in? Where do you play in the capital structure? And would you describe your strategy as more core or opportunistic?
Hello, everybody. Rick Miller, private credit at TCW. We have three strategies. We focus all of those strategies in the core middle market. So think 15 million of EBITDA on the low end, 75 to 100 million on the upper end, but it's all core middle market. It's not creeping into the BSL or other areas. We have a premium spread product. That's our core strategy. That think of 650 spread or higher. That's more opportunistic. It's our specialty lending vehicle. We have a distress vehicle. We call it a rescue vehicle, which is providing liquidity to liquidity-challenged borrowers, which there are more and more of in our market. And recently, just a little bit under a year ago, we signed a joint venture arrangement with PNC Bank to provide loans, cash flow loans, primarily to their clientele. So three very somewhat differentiated strategies in the core middle market.
Ken Kencel, I'm President and CEO of Churchill Asset Management. We manage roughly $50 billion in committed capital, split equally between traditional senior lending and junior capital, which includes both equity co-investments and fund commitments. We focus exclusively on the core and upper middle market, so really staying within that, that range, and we've done that historically. We do move up and down the balance sheet. So we have senior lending products, we have junior capital, we have equity co-investments, we have a secondaries business, and we focus exclusively on companies that are owned or controlled by private equity.
Good morning, I'm Tim Lauer. I'm the CEO and CIO of Willow. We are a middle market core lender to, for the most part, sponsor-backed companies. We manage about $6 billion of assets under management. We tend to focus on the core middle market, occasionally doing some lower middle market. And in those situations, we'll provide junior capital to unlock both equity and sub-debt financing for businesses that don't have that access to capital. It's one of our alpha creators within our strategies. Pleased to be here on today's panel. Excited to dive into the competitive landscape.
And I'm Steve Kuppenheimer. I'm head of private credit for Lord Abbett. We are a 95-year-old private asset management firm. We are focused on core middle market lending, like a lot of members of the panel here. We do play down in lower middle market as well. We're part of a $50 billion leveraged finance business, but we're primarily a core strategy, not an opportunistic strategy.
Okay, very good. We've certainly seen a changing landscape in corporate private credit with a tremendous amount of growth over the last several years. A lot of new entrants into the space, and we've seen the large firms getting even larger, and the emergence of this theme, which is large cap direct lending. With that as a market context, we'd like to hear from you. How does that affect your positioning in the market and the supply and demand for capital in the segment where you're participating? And Tim, if you could kick us off there.
Sure, I think there are a couple of themes that are underpinning the competitive landscape in the core and particularly lower middle market. We've all seen that inflows are tremendous. There's a lot of new entrants. But I think when you peel it back, 90% of the dollars are going to the top 5 or 10 managers. And so the core and the lower middle market is, in my mind, not getting more competitive. I think, secondly, there's been quite a bit of M&A that's happened in the last 2 years when you think about Twin Brook and Treeline and Varagon and MGG, all changing hands. And that tends to bring some disruption to those businesses. On the other side, you're seeing the largest managers with all the capital being raised moving up and out of the core middle market. You don't see the Apollos and the Ares and the Interis as much in a $20 to $30 million EBITDA business. Certainly, you don't see them at all in a $10 million EBITDA business in terms of competing for that financing. So I think in this market, even though M&A volumes are low and issuance is low and spreads are tightening, we actually think the competitive landscape over the last 3 or 4 years has improved dramatically to our benefit as lenders.
Rick, what would you add to that?
Well, I think you've heard in our introductions some of the concentration of the core middle market is really focused on serving the private equity borrower. And I think the number is somewhere on the order of 80 or 85% of the capital is doing that, which leaves a lot of white space or a lot of untouched areas for those lenders that are focused on kind of maybe owner indifferent, whether it be non-sponsor or selected sponsor transactions. So I think a lot of I would agree with the comment of the concentration going to, I don't know, maybe it's 10, 12 managers who are getting bigger and bigger. You get, as an investor, you're going to get more and more of kind of a go-to-market process, right? They all have the page in their deck that has the 100 sponsor logos and that say this is our district, this is our origination channel. And I think as an investor, do you need 5 of those? Do you need 6 of those? I think it's an opportunity to kind of look outside of that story into other areas, whether it be lower middle market, non-sponsor, owner indifferent, premium spread strategies, more distressed or opportunistic strategies. So a lot of this, I think, probably is tied to the evolution and the maturation of the market. It's now 12, 13 years old, so it's an adolescent. It's kind of, you really don't know what direction you're going to go into, but it's not the same strategy that may have been very, very effective over the last 10, 12 years.
Fair enough. Ken, anything to add to that?
No, I think what we've seen certainly over the last year has been quite an evolution, right? We had several years where there really was no broadly syndicated loan market, right? So you saw some of the largest direct lenders move up to fill that need. Obviously, the CLO market and the liquid markets came roaring back in the first quarter. And that market was largely driven by refinancing activity. I think 90% or so of the large cap BSL market is really refi. And direct lenders continue to control the vast majority of the new deal activity. So I think in that sense, direct lending, private credit, and the liquid markets, are very much coexisting, right? And particularly as you get larger, companies are looking at both markets in terms of solution. But I think at the end of the day, the speed, the certainty, the confidentiality that we can provide, is an inherent advantage that I think makes direct lending, stand out. I will say, as we've evolved through the past several years, there's no question the largest managers are attracting more capital. They're demonstrating performance, and through obviously an environment where interest rates are 400 basis points higher. So I think as managers validate their performance, they raise more capital, gives them more scale, and the ability to compete in the core middle market, and in some cases even larger upper middle market deals. So I definitely think it's a case of a more consolidating market. And I also think that for newer entrants today, they're going to be largely consigned to the smaller deals. So we think that the core middle market, companies with $25 to $100 million in EBITDA, are kind of the sweet spot, if you will, where companies are big enough to have scale, but not so large as to have graduated into the covenant light, lots of leverage, lower pricing dynamics. So I think it all bodes well for private credit.
Okay, very good. Steve, let's drill into some of the dynamics in the market and ebbs and flows across the private credit markets and the BSL market, the capital markets. And with this new theme that's playing out, where the partnerships are being formed between banks and private credit managers as banks move to this originate to distribute model, what would you expect for 2025 in terms of the market dynamics and where we're going to see the most activity?
Sure. Well, first I'd say, and Ken touched on some of this, but the interaction between the liquid loan market and the private market, it continues to converge. I think this really started in earnest with the onset of COVID. Up until COVID, I would say, pretty much all the major players were middle market lenders. And with COVID, you had 2 things happen around the same time. You had a few of the largest platforms get big enough to write $1 billion loan to a single borrower. So by definition, that's a borrower that can access the capital markets if it chooses to. But then with COVID, you had those capital markets dislocate. And now that private capital became kind of the game in town. And that, at the same time, there's a lot of proof of returns for private lending, direct lending through crisis. So you had a lot of capital formation, a dislocated capital market, and a lot of the largest players kind of moving in earnest into that space. And now when you look at it, I think you can, in somewhat, I think you're hearing this from the stage, there's there's multiple ecosystems within direct lending, but for these purposes, maybe there's two major ones. There's, direct lending where you're a private solution to a company that has a choice, the upper market, or you're a private solution to a company that doesn't have access to the capital markets. And those two things behave differently. And so of course the interaction with BSL and direct lending has to do with that upper end of the market. I think you'll continue to see the pendulum swing. So with COVID, the pendulum swung very far one direction. You saw a huge amount of large borrowers issue in the private market as call protections come off since COVID, and the capital markets are, of course, quite vibrant now. You've seen that pendulum swing back. Now where I think it is, with rates kind of, stabilizing where they are, capital markets still vibrant, I think that what you're gonna see now is more idiosyncratic in issuers deciding whether to issue public or in a liquid format or a private format. Ken mentioned a couple of these, but your private solution, you don't need a rating, you don't need to go on a marketing roadshow. You can have confidentiality. So if it's a take private transaction, it can be a much more customized solution for a borrower who's got a complex capital structure. Those are all advantages that I think throughout markets can win. At the same time, the liquid markets are cheaper, and you're going to get out to a wider investor base. So I think in 2025, I wouldn't expect a big swing one way or the other. I think you'll see more of these idiosyncratic choices between the two markets. But I do think another aspect of this is the documentation. A lot gets talked about with covenants, but I think another related topic is what's referred to as lender-on-lender violence, which is really what we mean by that is lenders who came into a borrower at the same level find themselves all of a sudden not at the same level in times of stress. So it's not just a company that has bad performance, it's an unexpected outcome with respect to the seniority of your loan. And the more liquid loan documents permit that type of kind of side transaction, and the core middle market documents generally don't, or I would say more than generally don't even contemplate it generally. So I think that you'll continue to see those differences, but for 2025, I think it'll be more idiosyncratic.
Okay,
Between.
very good, thank you. Well, let's move on and talk about the macro a bit and focus on credit performance and different views being expressed in different parts of the market and by different people around credit quality. And certainly we've got a strong economy, but not all companies, not all sectors are experiencing that equally. And so let's focus on where credit is today, what your expectations is for credit performance of existing assets, and then what's the outlook as you think about the uncertainty in the market, the rates, the policy, the tariffs, all the factors that create the uncertainty today, and how you're thinking about portfolio construction for this year. And maybe, Ken, maybe you can kick off on that one.
Sure. Well, look, I think the big surprise, or certainly the big learning from the last several years, is that direct lenders, certainly the large-scaled relationship lenders with strong track records and a long history, really proved out the asset class, right? Interest rates are up 400 basis points. There was a lot of speculation around, could these companies really handle, going from 7% to 11%? What would that do to balance sheets? Would these companies be impaired? And I think for the firms that have followed a conservative, focused, highly diversified approach to investing and generally focused on higher quality businesses, the reality is that portfolios are in actually very good shape. KBRA DLD, I think for 2024 is forecasting a default rate of around 2.5% to 2.75%. Still very, very reasonable to historical standards. If you look at our portfolio, for example, we're sitting with a default rate of 0.1%, and I would bet that a number of the more successful direct lenders would have similar numbers. So I think credit quality has been good. The dynamics today absolutely favor managers that have scale, that can deliver large-scale solutions, that have relationships, and fundamentally, have kept their focus on a more conservative profile. So current state of affairs, I think, quite good. Deal activity, if you look across the past year, has picked up quarter over quarter. We actually had a record year of investment activity last year. We invested over $13 billion in over 400 deals, and we think 2025 is going to be even better. So yes, there's a lot of noise around tariffs, and I tend to be a doubter that those actually will materialize. So I think the outlook of rates being somewhat higher for longer, the fact that portfolios have been able to withstand the higher for longer environment portends very well for yields for investors, but also an environment where companies have shown their ability to handle it. So direct lending, I think, and private credit should have a very good year in 2025, and we're expecting to be quite active. So I'm quite optimistic about the environment today.
Yeah, I would agree. I would say that there's a couple of things that have happened over the last 20 years or so that I've been investing, and the folks in this panel have been investing in private credit. And I think one thing that doesn't get talked about enough is that private equity's become very expensive. And the reason why people choose direct lending over a broadly syndicated loan market is they constantly need capital. And those markets open and close, whereas if you're a lender with capital, you can always provide that solution. And so the duration of risk in 2002, 2004, when this asset class was starting, was generally tied to a mezzanine product, where you would look back at a company's performance 3 years after closing, and you determine whether or not they made their budget. Today, it's every 3 to 6 months in every sector that a company is calling this panel back for more capital. And so that means that you're able to re-underwrite risk, whether that's risk related to the company, macro, tariff, interest rates rising, and make adjustments. I think that's a really important thing for the asset class. In my mind, it's gotten so much easier to deploy behind borrowers. And when we first started doing this, this was maybe an industrial roll-up or a healthcare roll-up where you see consolidation and a synergy model. Now it's everything. If you're paying 20 times for a software business, an A&D business, an HVAC business, you're going to have to buy that multiple down. And the only place you can come for that capital is to a direct lender. Broadly syndicated loans cannot be structured with delayed draw term loans. And so that's why you're seeing $3 billion, $4 billion, $5 billion financings get done. We're the only source of that dry powder. So I think all of Ken's comments around the economy working and defaults remaining low, I think they're valid. I think you're going to see a few sectors, which we have seen, start to experience exaggerated defaults. And I would pinpoint technology-related lending, recurring revenue loans. You can look at public BDC data, and there are several that are at 40% PIK. Those funds are not going to make their dividends. So I think that's not something we do. I think that's not a market we thought made sense in terms of spread versus earnings. But the managers that have maintained discipline as this asset class has grown are the ones that are going to continue to show strong performance.
Rick, what are your views on credit and expectations?
Well, I think, first of all, maybe starting at the top in macro, the world voted for volatility, okay? There was an inordinate amount of elections around public democracies around the globe, and the incumbent lost almost uniformly. And so people voted for change, good or bad, they voted for volatility. So I think there's going to be surprises. When you look at the credit markets, both public and private today, you can argue that the markets are mispricing risk. You've got record tight spreads in IG, record tight spreads in high yield. Spreads have come in private credit over the last year. So the market is certainly pricing for little error, little margin of error. And you take now back, you kind of winnow that down into what we do every day. As a private credit manager, direct lending manager, you have one objective: avoid principal loss. And if we're successful at that, you can generate attractive risk-adjusted returns for your investors. If you don't do that, you're probably looking for a job. And so the idea of mirroring that volatility with that objective, I think some of the themes here I would echo, consistent risk mitigation and consistent discipline around the way you lend. But I think maybe more importantly, some of the attributes that have not been as appreciated over the last 10 or 12 years in the private credit market, which has, the private credit market has really grown up in this incredibly benign investment climate. 0 interest rates, we're not allowed to have recessions, no defaults, and so we're all, geniuses. You can just ask us. But if you kind of, look at today, a more normal environment where you have much higher rates, you have economic uncertainty and volatility, I think the traits of a lender that knows restructuring, knows bankruptcy experience, is capable of owning and operating when necessary. All skills required to avoid principal loss are going to be things that I think characteristics that investors are going to value in their managers, because it doesn't matter how you get there, you just can't have those losses. And in order to avoid those losses, you've got to make some difficult decisions. You've got to be confrontational at times with your borrower. And I think you're going to see a dispersion for maybe the first time in the young asset class life between managers who have that experience, have that expertise, that knowledge, and those who don't.
Fair enough. Let's switch gears and focus on the right side of the balance sheet. And Steve, maybe you could lead us in a discussion here about how private credit managers in the corporate space are financing their portfolios. Certainly the banks are feeling a little bit more front-footed because they're not going to be under the regulatory pressure that they thought maybe they would be. But I understand some of them are getting full on some of the names in the space. But also, what are you seeing, like the private CLOs, the insurance capital, regular way bank financing? What's happening in the right side of the balance sheet there?
So I'd say financing of private credit is very healthy right now. And maybe your previous question to me had to do with the bank's overall relationship with this market. And I think this is a great time to weave that answer in as well, where if you went back to the great financial crisis, before the great financial crisis, or maybe just the history of direct lending in general, it's very bank driven. Banks were the providers of a lot of capital that we provide today. If you go back 20, 30 years, and starting with the GFC, they started to get regulated out of it. Basically, the risk capital they have to hold against it makes it uneconomic for them if they're just holding the loans itself. What that's turned into is the banks like the risk quite a bit, but they really have moved to a second loss position in financing what we do. And that is very vibrant. If you look at how private credit is levered, it's actually quite conservative. It's on average for a leverage, so a lot of what we'll manage may not even be levered, meaning the fund. But if it is levered, it's usually targeting a 1-to-1 leverage ratio, and you're talking about senior secured loans. If you compare that to, let's say, banks and CLOs, other kind of pools of senior credit risk that are levered, banks today are levered about 10, 11 to 1 as are CLOs. Back in the GFC, banks were levered almost 30 to 1. And so from that perspective, you've got term financing at a modest leverage that's kind of matching underlying term of private lending that's had a very stable history. So the financing of the product on a risk-adjusted return basis has proven to be quite attractive. So I think the banks are leaning in pretty notably. And if you're managing a private fund, that's really the leverage you're looking at generally, is kind of bank financing. You also mentioned CLOs. Maybe we'll talk about a few other ways the strategy gets financed. If you're a BDC, you're an actual operating corporate finance company, and you have the ability to issue some other instruments. So you can issue a corporate revolver that also comes from the banks. They don't like that as much because it's not funded, but they'll do it for the relationship if there's other kind of deeper economic ties, which usually there are with these firms. So being a BDC allows you to issue a corporate revolver, also allows you to get rated yourself, and a BDC can often get rated BBB and issue its own unsecured bonds. And so now you're not even taking up bank balance sheet. In fact, that's a fee experience for them, where they place those bonds to insurance companies, funds, other kind of rating sensitive investors. And that market has grown from 10, 15 billion to almost 100 billion. And it used to be maybe 25 investors in for that product. Now I'd say there's 200 investors for that product.
You know, I would mention another point on the financing side that I think is quite interesting. You know, if you went back 5, 10 years ago, pretty much all of the funds that were being raised were term funds, 3-year, 4-year investment period, which made it a little bit harder to finance, right? So you'd have to ramp into the financing, and then just when you had the leverage in place, the funds started to run off. I think a big trend in the industry, which we've seen, is a move toward perpetual vehicles. And by having a perpetual structure, you can raise long-term financing, you know, within that structure. So you're seeing more utilization of CLOs, more utilization of term financing.
7 to 10-year paper.
10-year paper. And so I think that's healthy as well, because what you find is those portfolios get larger and larger and more diversified, right? So in a perpetual fund, you could have 200, 300, 400 borrowers in that vehicle and raise capital in a more diversified profile. So I think that lends itself to utilization of financing as well.
And I think the private credit CLO market is also very vibrant, where a lot of historic CLO investors have found a lot of relative value in the space. You can get a AAA rated piece of paper for, depending on the market you're in, you know, somewhere between 30 and 60 basis points wider of a broadly syndicated CLO AAA. And again, the performance has been terrific for decades. So I think the financing is quite vibrant for the space, and maybe you're seeing so many more providers that leverage come in. It's probably as good as it's ever been. And you've got to, you know, juxtapose that with you know, kind of capital being raised for fund managers like ourselves.
Okay. Well, hopefully that gives everybody a sense for some of the dynamics in the competitive landscape that are playing out today in the private credit space. A look into the views on credit performance and what to expect there, and what's happening in the financing market. So thank you so much for all your observations and insights.